we've had over 4 decades of structurally declining interest rates until they hit zero, they hit negative in some cases. Um, and when you have ever rising debt to GDP, there was a lot of alarmism about that back in the 80s and 90s. But what they didn't anticipate is you would have decades of declining interest rates. If you double your debt, but you have your interest rate, then your interest payments remain the same, especially relative to your growing income. And so, that's been a kind of a balanced force for a while. The problem is when debt as a percentage of GDP is still rising, but interest rates hit zero, bounce off zero, and start going even just sideways in kind of this more moderate band, then those fiscal deficits start to kind of get out of control. In addition, there is a valuation bubble in some of those spaces. So back in 2019, I wrote about the bond bubble, kind of emphasized it again in 2020 and 2021 as kind of the early stage of this kind of fiscal injection started to play out. And the issue there is that when bond yields get super cheap, it basically means that bond prices are very overvalued. Um, Bond proxies, like for example, utility stocks or defensive consumer staple stocks, they get very expensive. And then the other area that's really impacted is VC, or broadly any sort of unprofitable tech, including publicly traded ones, because they've been in an environment where interest rates are so low, so the opportunity cost for usage of capital is low. And so people are very willing to monetize equities. They're saying, well, I'm getting zero return on my cash anyway. I might as well hold this long duration tech play, even if it's got no clear sight to profitability anytime in the near term, because my opportunity cost is zero and getting devalued.
In Lyn Alden's recent analysis, she highlights a critical shift in the financial landscape: the impact of near-zero interest rates on investment strategies. Over the past 4 decades, interest rates have steadily declined, even reaching negative territory in some cases. This trend has fueled a surge in debt-to-GDP ratios, leading to concerns about fiscal deficits spiraling out of control. Additionally, the low interest rate environment has inflated valuations in bond proxies and unprofitable tech stocks as investors seek higher returns in equities. However, as interest rates begin to stabilize, there's a looming reassessment of investment strategies with a focus on profitability and sustainable growth.
So they bid very high valuations. And what that does is that these companies can then issue a ton of equity to kind of cover their losses and keep operating their business. They can underprice their goods and services and therefore emphasize growth at all costs. And the problem is that if it returns to that there's a cost of capital, that if you can earn 3, 4, 5% by holding fairly safe money or money-like assets, the valuations you pay for these companies is lower, which impairs their ability to cover costs by just more and more equity issuance, which then means they have to try to raise prices and get a little bit more towards equilibrium, which then slows down their growth a little bit, which then has a feedback loop of making the equity valuation even lower until it kind of right sizes to the point where it actually finds out, okay, what is the actual total addressable market of this company if the prices are not artificially low because of the expectation of just endless equity issuance. And so basically, it's just that the magnitudes all get tweaked back in that kind of bond bubble that existed, and it's painful to go through a period to say, okay, how can we separate the wheat from the chaff here? So what kind of companies only existed because interest rates were zero versus which ones are still very valuable, but that might just have to be right sized a little bit in terms of valuation or growth expectations because they have to align a little bit more towards profitability and a little bit less towards just ever constant equity dilution because of exceptionally high equity valuations. So that's kind of the one of the more disrupted areas, and it just changes the magnitudes of a lot of these things. And it's important, I think, going forward that I think we're probably in a more sideways choppy band for interest rates. There probably is a cost of capital going forward, and that makes it so that when you model out what you can pay for an idea, it just changed the equation to some extent and adds a little bit more conservatism back into that because it's not an environment where there's zero opportunity cost anymore.
In the next discussion, she delves into the complexities of central bank actions in combating inflation through interest rate adjustments. Traditionally, Raising interest rates served as a tool to attract foreign capital and slow down money creation by curbing bank lending. However, with today's staggering public debt levels and slower bank lending growth, interest rate hikes may not effectively tame inflation as in previous decades. The challenge lies in the fact that large fiscal deficits contribute more significantly to money supply growth, overshadowing the impact of interest rate increases. Alden emphasizes the importance of owning real assets, especially those that are scarce, as a hedge against potential inflationary pressures.
When central banks raise interest rates to try to reduce inflation, there's two main mechanisms that they're targeting. One is they want more foreign capital to hold that currency. That matters more for non-reserve currency. So, for example, if Turkey's experiencing massive inflation, but their interest rates are very low, everybody wants to get out of the lira. No foreign entities want to hold the lira because real interest rates are negative. And so one of the ways to fix that is increase interest rates so that more people want to hold it and fewer people want to flee it. And then that can help stabilize it. So that's number one. Number two is that in most decades, most money creation comes from bank lending. So as banks lend, they create net deposits in the system, particularly if they're lending at a faster rate than debts are being paid back. The overall kind of the broad money supply is increasing because of that lending. And so one of the ways to slow down money creation is to slow down lending. And having higher interest rates, changes the borrowing calculus and ability for borrowers to kind of take out money and service debt. So they're more judicious with how much debt they take, and lenders are more judicious with who they're willing to lend to and how much, and compared to what asset values and things like that. So that slows down money creation there. A big challenge, and what makes this period different than the 70s, is so back in the 70s, public debt was very low, and most of the money supply growth was coming from that bank lending. And so by raising interest rates sharply, it reduced bank lending considerably, even though it had other effects like increasing the deficit, for example. Well, when you fast forward to, back then it was 30% debt to GDP. If you fast forward to now and you have like 130% debt to GDP, the problem is that bank lending is slower than it used to be, partially because of demographics and other factors, and deficits are larger than they used to be because there's so much accumulated debts and all the interest expense on that debt. And so the problem now is when you raise interest rates, you do put some downward pressure on bank lending, but the increase you get from deficit interest expense is larger. And so you actually risk not really slowing down money supply growth by raising interest rates. And so that's kind of the challenge, that you can get to a point, and I don't think we're kind of flirting with that point now, which is that interest rates become a less effective tool for slowing down inflation, compared to what they used to be if you had low public debt and rapid bank lending. Instead, the large fiscal deficits are more at the core of why money supply is increasing, and the central bank tools are not really designed to deal with that. And the highly politicized political apparatus is not really well suited to kind of fixing deficits anytime soon. And so the risk is that's just like a background long-term thing that's here now. Um, and measuring how it's going to be inflationary or not, I think really comes down to the rate of technological growth. If we're, if AI makes a bunch of services cheaper, and if we are constantly, kind of developing new commodity deposits and energy deposits, and so we're not getting bottlenecks there, then we can keep inflation pretty low, and a lot of that money supply growth kind of goes into asset price inflation. So Nasdaq keeps going up, Bitcoin goes up, real estate, waterfront real estate goes up, all this. That's where the surplus accumulates. On the other hand, if the technology growth is not as fast as that rate of just kind of constant deficit monetization that tends to happen over the long term, and especially if we're not, kind of keeping up with energy and commodities, then that's when we risk getting outright kind of significant CPI inflation. And so those are kind of the two paths going forward, which is one, interest rates are not really the anti-inflation tool they used to be. And so instead, it really comes down to you want to own real assets. And then when it comes down to which real assets you want to own, it's basically which ones are scarce. So if you expect that energy capex is going to be tight, maybe you want to own energy stocks, for example. On the other hand, if you think that's going to be not a problem, then owning NASDAQ stocks or owning waterfront real estate or owning Bitcoin. Those are the types of assets you want to own. By the way, uh, treasury bonds are likely not where you're going to make your great purchasing power in the years ahead because it's just this ongoing kind of fiscal spiral. It's like a slow motion. It's kind of what happens to emerging markets, just at a less extreme level.
In today's insightful discussion, we've explored the intricate dynamics of interest rates, fiscal deficits, and their implications on inflation and asset valuations. Lyn Alden's analysis highlights the evolving nature of monetary policy tools and the importance of owning real assets in navigating economic uncertainties. Remember, in today's landscape, traditional anti-inflation measures may not be as effective, emphasizing the significance of strategic asset allocation. If you found this information valuable, don't forget to subscribe to our channel, like this video, and share your thoughts in the comments below. Stay informed, stay empowered, and thank you for watching.